Coming up on Market to Market. Gusty winds and bone-dry forests fuel wildfires in Colorado and New Mexico. For the second time in a year, the Senate approves its version of the Farm Bill. And despite planting delays, the government calls for record grain and oilseed production. Those stories and market analysis with Darin Newsom next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, June 14 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. It's shaping up to be a particularly severe wildfire season in the West. Officials said late Friday they're beginning to turn the corner on a lethal outbreak in Colorado. Just over 36 hours after one of the fires began in the Black Forest region northeast of Colorado Springs, the lethal blaze had blackened 25 square miles. Black Forest contains one of the largest contiguous stands of ponderosa pine in the nation. The land is highly prized for development, and it's dotted with multi-million-dollar estates. But over the past few days, many of those homes went up in smoke. Lightning strikes, strong winds, and bone-dry conditions sparked several wildfires this week in parts of California, New Mexico, and Oregon. But the charring of Colorado has done the worst damage. Called the most destructive wildfire in the Rocky Mountain state's history, the blaze in Black Forest has claimed nearly 400 homes. Thousands of residents have been evacuated, and about 1,000 medium-security prison inmates have been transferred to other facilities to escape the inferno. The wildfires are threatening nearby Colorado Springs, the state's second most populated city, and have also caused damage to the iconic Royal Gorge Bridge. The fire in Black Forest is just one of several to break out this week in Colorado, where memories of wildfires in recent years have spurred residents to move quickly.
I think everybody's afraid after the fires last year, so I think people are getting out a little faster this year.
I think we've eclipsed.
El Paso County Sheriff Terry Makita says he's concerned for some residents who may have ignored evacuation orders.
Part of the assessment we're going to be going through is verifying those locations where people did not evacuate. And one of my worst fears is that people took their chances and it may have cost them their life.
Those fears may have been validated midweek when the bodies of two residents who appeared to be fleeing were found in a garage. This week's drought monitor reveals large portions of Colorado and neighboring New Mexico sweltering in extreme to exceptional drought. Arid conditions are expected to continue in the American West, and lightning strikes have ignited fires in the southwestern part of New Mexico, in a region that hasn't been scorched by wildfires in decades. Colorado Governor John Hickenlooper authorized more than $10 million to extinguish the flames in his state, and later in the week, authorities managed to battle the monster fire still combusting Colorado to some semblance of a draw. Despite federal spending cuts and tax increases, U.S. consumers increased their spending last month, particularly at the local car lot. According to the Commerce Department, retail sales increased 0.6% month over month in May, in their best showing since February. The improvement was driven by a 1.8% gain in auto sales, reflecting their biggest increase in 6 months. But even when the volatile transportation sector is excluded, sales still rose a solid 0.3%. Separately, the government reported that the number of Americans seeking initial unemployment benefits dropped by 12,000 last week to a seasonally adjusted 334,000. And the notion of declining unemployment and increased consumer spending was cheered on Wall Street, where the Dow snapped a 3-day losing streak Thursday with a gain of nearly 200 points. Improving economic data this week have been supported by Federal Reserve policies designed to keep interest rates low. Fed policymakers will hold a 2-day meeting next week that will be closely watched for signals that the Fed might scale back its monthly purchases of $85 billion worth of mortgage bonds. This week, though, the focus shifted from monetary policy to that of agriculture. And as Yogi Berra once said, it's like deja vu all over again.
This vote, the yeas are 64, the nays are 35. The 60-vote threshold having been achieved, the bill is passed.
It felt like 2012 all over again this week as the U.S. Senate passed its version of the Agriculture Reform, Food and Jobs Act. Better known as the Farm Bill, the measure won approval Monday night with little debate. The legislation preserved much of the Senate Ag Committee language and would cost about $100 billion per year to the taxpayer. The bill continues to greenlight food and agriculture programs while trimming money for environmental programs, farm subsidies, and nutritional programs. The Senate would cut 0.5% from the Supplemental Nutrition Assistance Program, or SNAP, but would not restrict eligibility for the program formerly known as food stamps. That food assistance portion of the bill continues to be the most contentious, even as those who voted for the bill, like Iowa Senator Charles Grassley, admit there's plenty of work to be done.
The stimulus period's over, so we need to go back to the original intent of the food stamp bill, because if it hadn't been for stimulus, this food stamp bill wouldn't have been expanded to the great heights where it is. We've gone from 28 million to 49 million people on food stamps in about a 4 or 5 year period of time.
Other critics of the Senate Farm Bill contend there's still way too much spending. The measure faces an uncertain future on the other side of the Capitol, but Speaker John Boehner indicated this week he would vote for the House version. Boehner's support is seen as a major boost for the bill that never made it to the House floor last session. The Ohio Republican also voted against the 2008 Farm Bill and says he has concerns about the measure, but conceded no changes can be made if no action is taken. With annual costs of about $78 billion, SNAP spending has more than doubled since 2008. But the House version would cut SNAP spending by 3% and make it harder for some people to qualify for assistance. Direct payments that compensate growers regardless of price or yield would also be eliminated. Nevertheless, the Heritage Foundation still believes the House version is too costly, and the conservative think tank has taken to the radio airwaves to target 4 members of Congress, including House Ag Committee Chairman Frank Lucas in his home state of Oklahoma.
You can put a tuxedo on a pig and call it Steve, but it's still a pig. But only 20% of the funds would go to support farmers. The rest would go to bankroll President Obama's food stamp agenda.
The ad calls out the Oklahoma Republican for supporting the spending of $1 trillion, calling the measure fiscally irresponsible. However, more than 50 regional and national agribusiness groups expressed support for crop insurance expansion and opposition to amendments aimed at curtailing the bill's effectiveness. In a letter, the group stated, "Crop insurance is different than traditional farm policy, and any amendments should be cautiously considered." The letter goes on to say, as with other lines of insurance, crop insurance requires a broad pool of participants to function properly. Amendments to arbitrarily cap premium support or assign a means test for support will impact the pool of participants nationwide, both in the near term and longer term. The agricultural groups, including the American Farm Bureau and National Farmers Union, note crop insurance allows farmers and ranchers to secure operating capital to help feed the world. The letter was addressed to House leadership and all members of Congress. Speaker Boehner says the Farm Bill will likely be debated this month and could make it to the floor as early as next week.
Next, the Market-to-Market Report.
Mother Nature continues to hold the cards in the grain and oilseeds markets. Favorable conditions east of the Mississippi River prompted some discussion this week of record-breaking crops in some parts of the eastern Corn Belt. But further west, where cool and unusually wet weather delayed planting for weeks, things are less certain. Farmers have made significant progress, but the full impact of persistent rainfall in key growing states like Iowa, Minnesota, and Nebraska remains to be seen. But that didn't stop government swamis from gazing into the crystal ball this week. And in their latest crop production report and supply and demand estimates, USDA analysts predicted America's farmers will harvest record corn and soybean crops this fall.
U.S. farmers were able to plant nearly 90% of the nation's corn crop over 2 weeks in May, but weather delays have kept them from completing the job. With half of June gone, a scant 5% of the coarse grain remains unplanted. USDA officials cut yield estimates slightly from last month to 156.5 bushels per acre. With nearly 98 million acres planted, production is expected to hit a record 14 billion bushels. Some of the corn planting stalled by inclement weather has been replaced by soybeans. Those running hard to finish are still 30% behind last year. Regardless of the possibility that farmers will end up planting more acres, officials left their guess for 2013 soybean yield unchanged at a record 44.5 bushels per acre. The forecast sets the stage for a chart-topping harvest of 3.39 billion bushels. And predictions for this year's U.S. wheat harvest were increased 23 million bushels to just over 2 billion bushels. If realized, that would be 500 million bushels below last year's record crop and well out of the top 10 wheat harvests. Turning to last year's crop, corn sold for feed, ethanol, and other uses is expected to result in tight ending stocks of 2 billion bushels. However, closer examination reveals the new crop stocks-to-use ratio is expected to be 2.5 times higher than last year. That development has private analysts predicting new crop prices will be driven lower by as much as $2.50, dropping to an average price of $4.40 per bushel, which lines up with official estimates. Debate over the actual amount of corn available is expected to keep prices volatile. Globally, supplies are projected to be adequate as ending stocks for new crop corn were raised to more than 150 million metric tons. Commodity traders viewed the report as bearish, and new crop corn contracts fell more than 13 cents after the figures were released on Wednesday. After factoring in feed use, crush for oil, imports, and the moving target that is soybean acreage, the projections for old crop soybean ending stocks remained unchanged at 125 million bushels. USDA officials say foreign buyers taking their time to switch over to South American suppliers resulted in larger stockpiles. The stocks-to-use ratio for the new crop is expected to be more than twice as much as last year's, which was the tightest in nearly a decade. Despite the prediction, private analysts are confident the crop will be able to meet projected demand and provide some cushion. Public and private prognosticators viewed the new crop numbers as bearish and predicted a jaw-dropping tumble of $4.40 per bushel to an average price of $9.75. Globally, supplies are deemed adequate, but some private analysts see little room for crop shortfall in the future. USDA is expecting the South American crop to play heavily into what finally happens, but that's predicated on estimates of record production in both continents. Also, Chinese demand is expected to be a factor in price volatility. The data woke the bears on LaSalle Street, and the November contract fell 13 cents per bushel on the news. USDA analysts increased their estimate for old crop domestic wheat supplies to 746 million bushels, mostly due to decreased exports. New crop supplies are tighter than in the past 4 years. Once food, seed, and feed needs are handled, the carryout is expected to be 659 million bushels. The resulting stocks-to-use ratio for new crop wheat is expected to remain tight, as it has been for the past 5 seasons. Private analysts say domestic and world stocks are adequate, even though supplies are failing to rebuild stocks like other grains. USDA expects prices to strengthen by a dime to an average price of $6.90 per bushel, 90 cents less than officials had initially predicted. The market followed a downturn in new crop wheat from the previous day, and prices declined nearly 14 cents on the news.
Notions of record corn production weighed heavily on grain prices this week, despite a weaker dollar. For the week, July wheat lost 15 cents, while the nearby corn contract moved more than 10 cents lower. Old crop soybeans also headed south as the July contract declined by 12 cents. Nearby meal prices followed suit with a loss of $1.80 per ton. In the softs, cotton had another positive week as the December contract posted a weekly gain of $4.26 per hundredweight. In the dairy market, July Class 3 milk lost more than 60 cents, while the August contract declined by 50 cents. Over in livestock, the August cattle contract lost 96 cents. August feeders were off 33 cents, but the July lean hog contract gained almost $1.50. In the financials, the euro gained 121 basis points against the dollar. Crude oil advanced by nearly $2 per barrel. COMEX gold gained by $4.60 per ounce, and the Goldman Sachs Commodity Index moved less than 5 points higher to settle at 630.60. Here now to lend us his insight on these and other trends is one of our regular market analysts, Darin Newsom. Darin, welcome back.
Good to be back, Mike.
We mentioned there in the market outlook, this past week we did see a little bit of a weakening of the dollar. And there's concern that that's going to reflect in higher prices for commodities. Right. What are your thoughts on the dollar's outlook?
You know, short term, we could sure see the dollar continue to come under pressure. You know, it's got a little bit of a downtrend established. We've got some money coming out, but longer term, I just don't see it. I think the dollar is going to find some support in here in the coming weeks, and there just doesn't seem to be this groundswell of support for commodities. In fact, it's quite the opposite. We just don't have a lot of investment money coming into commodities right now, and that's one of the reasons why we continue to see lower prices.
Not a lot of reason to invest, not a lot of reason to drive the prices substantially higher from outside investors.
You know, because as you talked about in the piece before, you know, the drought situation isn't as bad, and that's always something that can help bring investment money back in. There's no real supply and demand issue at this point, and we've had the global equity markets move a great deal here in the recent weeks, some of them to new highs, and this is pulling money out of other investment sectors as well.
All right. Well, now as we talk supply and demand, we do have harvest underway, the wheat harvest. Can you talk to me a little bit about what you've seen, what reports you've heard on that harvest, and what to anticipate here?
Yeah, right now, estimates for an average to good to average harvest really are way out of whack. Everything that I'm hearing from the western third of the southern plains, stretching all the way down into Texas, is yields just really aren't there. Initial reports coming out of Kansas and the southern tier of counties in Kansas, 10, 15 bushels per acre. There's talk of south central Kansas, irrigated wheat, maybe, and this is irrigated, maybe making 20 to 30 bushels per acre. Dry land, again, 10 to 15. And it gets worse the further west you go. So I know we saw USDA, or actually it was NASS, increase winter wheat production in this week's report, and I find that fascinating and somewhat humorous in the fact that it's NASS weekly crop condition numbers, the same group that has been lowering these crop condition numbers every week for winter wheat. So conditions continue to come down, crops in worse shape, and then in a monthly report from May to June, they increase total production. For those who want to look at these numbers and try to read something into them and use them as and view them as valuable, I think that's evidence to the contrary.
And now for producers out there, as they're watching this market trade these USDA numbers, the NASS numbers that came out, we did see further slippage in wheat prices. Is that going to reverse once people get a full idea of harvest?
Probably. I mean, it's not unusual as harvest starts to get into gear that we see some pressure on any commodity, including winter wheat, July, Chicago, whichever one you want to look at. Both the July contracts in Kansas City and Chicago are trading near technical price support right now. Normally, they do tend to trade sideways to down. I think at some point, once we get to see some consistent yield reports coming in, probably put the brakes on any pressure. Now, is there a reason for the market to go up? No. Maybe we have a tighter supply, but we really don't have much demand either. Demand's really been curtailed. We're not seeing a lot of exports in wheat right now. So we could see a short-term bump in the market. The July SEP spreads in both Chicago and Kansas City looking quite bullish at this point, meaning we've got some short-term concerns. But longer term, we just don't see the demand to help push the market considerably higher.
So advice for producers as they're coming out of the fields with combines full?
Probably wait a little bit. I don't know that I want to sell right off the combine. I think there's a chance that we could still see this market rally once we realize, at least short term, once we realize that the bushels aren't there, that they never were going to be there. It was ridiculous to think that they would be. I think that's going to help push the market up short term until the reality of no demand really sets in.
Until that hits, which was a story we saw really last year in corn.
Right.
Talk to us a little bit about what we're expecting in old crop corn over the summer.
Well, the old crop corn market, I think, is fascinating in the fact that it's already been moved to the back burner. Everyone's focusing on all these new crop issues, but if we were to look at this July SEP spread, it's going out. It's like 90, 95 cents right now. The inverse, in other words, the premium that July holds over the SEP. This is telling us there is a great deal of concern over supplies, and basis continues to strengthen. So the cash market's strong. Future spreads are strong. The reality is we do not have the corn on hand that USDA says we do. It just isn't there. And if it is there, then it must be of quality that can't be used in the market. So we've got a couple different things going on, but by and large, old crop corn market remains bullish and should continue to find plenty of support from basically from domestic demand.
So advice to folks with old crop corn in the bins, let this week's shock work through the system and then maybe consider selling, or would this be a good time to?
Yeah, the July contract, the July SEP contracts, both of them, the SEP's still considered somewhat of an old crop contract, both performed relatively well this week. They didn't see the pressure that the new crop market did. So, if you're still holding on to some, probably don't want to hold on to it a whole lot longer. You've got a little bit of time in here because harvest is being pushed back for new crop. So I think it's going to give you some opportunities. Strong basis market. Anytime you've got a strong basis and an inverted future spread, you can pretty much pick and choose where you want to sell cash.
Now let's talk new crop corn. It's been the news lately. I mean, folks are giving up acres. What are your thoughts on abandoned corn acres? Prevent plant switching to beans. Where do you think we're going to see?
From what we hear from customers, the economical decision would be just to take prevented planting on corn and not go into soybeans. And so, you know, the latest crop progress report showed planting at 95%. I don't think we'll see a lot more. Maybe we get up to 96, something like that. That means we've probably got anywhere from 3.5 to 5 million acres that could be lost of the 97.3 that's being projected right now. So I do think at the end of the month, when the USDA rolls out its next acreage update on June 28th, we'll see a smaller number. I think that's where they will account for some of the problems that we saw this spring. So at that point, then we start to adjust some of these production numbers and so on. You know, we saw them back off yield a bushel and a half per acre in the June report. I think that's going to probably continue to come down as well. And for too long, we'll probably be back below the 14 billion bushel production number.
All right. Now, as we take a look at soybeans, old crop beans, similar story as old crop corn. We're seeing a lot of strength in the market.
Yeah, the fun thing about old crop soybeans is the magical math that goes on in each one of these USDA reports. So the way they move bushels around to maintain the 100 million bushel ending stocks figure. We were on pace to hit the export number of 1.35 billion bushels. In fact, old crop beans are still on pace to hit 1.4 billion bushels. Yet we took 20 billion bushels off this past week down to 1.33. Why? Because we increased crush, and we had to find some way to offset that. So we also increased our import number, leaving us at 125 million bushel. But again, July to August inverse, the premium the July contract has over the August tells us those bushels aren't there. They haven't been there for months. So we've got a very tight situation going on in the United States. How's that going to affect the new crop market? Well, that's the beginning stocks as we look forward to 2013, 2014. The smaller the ending stocks are for the previous year, the less we have to start off with when the next year rolls around.
Now, what's your advice to producers as they're anticipating increased wetness or increased drought in some area? How do they market new crop beans?
New crop beans, I think you have to be. I think you're still going to have an opportunity. I mean, this is a market where we've been talking about spreads. If we look at the Nov to Jan spread, there's not much carry in that. There's like a 5-6 cent carry right now. So that's saying that despite all this talk of record production and larger acres and all this, the commercial side of the market just simply doesn't believe it. They want it to be proven first. So it's still quite bullish. So I think we're going to have some opportunities. We've fallen back here over the last week or so. We've got some pressure up there around the 1380, 1385, up around the old high of around 1390. We've pulled back, probably testing some support here in the low 1280s, upper 1270s. But then I think we gather ourselves, we see how the weather plays out, gives us another chance, I think, to get some marketing done.
All right. Now, as we take a look at cotton, just very quickly, we've seen a really solid run-up in cotton prices over the past several weeks. Talk to us about what's happening there. What are we seeing?
Well, that's seasonal in nature for one thing. And as I look at my 5-year seasonal chart, it shows that this second week of June is usually when the new crop D's puts in a secondary high and then starts to move lower through into early August. So we'll see how that plays out. But what we've seen in the cotton market is we just continue to see the ending stocks of cotton continue to be whittled back as far as the new crop goes. So we've got a great deal of commercial buying coming in. Again, the D-Smart spread has moved to a very strong inverse, indicating a lot of concern over supply and demand. So you add that into some money coming back into the cotton market short term on the idea we're going to have tighter supplies, and it's been enough to push the market higher. Can it maintain this rally? If it does, it'll be a bit of a contra-seasonal move. So I would not be surprised to see it lose a little bit of momentum in here, start to come under some pressure again, maybe having nothing to do with supply and demand, more to do with the flow in and out of markets from investors.
Just a good selling opportunity up around this price
level. Could be,
because
it's had a very nice rally here over the last 2-3 weeks.
All right, well, let's take a look at livestock. Cattle have been pummeled the past couple of years. Talk to me about, we are still sliding down in live cattle. What do you see?
And I'm not laughing at the cattle situation. I'm laughing at this is a market that is completely completely ignoring its fundamentals. I mean, if we've looked at the June, August, now we're looking at the August, October spreads. This is indicating we've got a bullish supply and demand situation. We've still got, relatively tight supplies and relatively solid demand. The market will not react to this. It just continues to drift lower. And in fact, this week we saw enough pressure to reestablish the downtrend that we've been in, seems like forever. And can we turn this market around? We should be able to, but it just doesn't look like we're going to.
What's the shot in the arm that would turn this market around?
It's going to have to be some sort of huge. Number one, we're going to have to see the investors come back into this market. This is one they continue to ignore. Number two, we're going to have to see domestic demand pick up again. We're into grilling season now, but the weather just has not been conducive to get outside anywhere. So if the weather will start to cooperate, domestic demand starts to pick up, maybe this will give us a little bit of a spark, a little bit of hope here as we head into the summer.
But nothing on the horizon.
I don't see anything right now unless we just see some buying coming in on the idea that of all the commodities, or at least most of the ag commodities that we look at, maybe cattle's viewed as a little bit undervalued.
All right. Now, as we look at feeder cattle, same dynamic playing out?
Similar dynamic playing out, but the short-term downtrend that we've seen established in corn certainly seems to be providing some support to feeder cattle. Those two usually play off of each other, allowing that market to move up a little bit.
All right. Now, talk to us about the hog market. That's been on another nice little rally.
It's been on fire. We've got very strong commercial buying coming in, good demand for the hogs right now. This is kind of what we were sitting back waiting to see if it would happen, and it certainly has played out this spring and heading into the summer. So as long as we can maintain that demand, as long as we've got relatively bullish fundamentals, it looks like we're going to be able to continue to support this hog market.
Now, in a question of circumstances, cause and correlation, the run-up in the hog market did start around the same time the big Smithfield announcement happened. Is there a correlation there or causation?
If there is, it comes more from, because there's all this talk that will increase our exports of hogs, of pork. We did see that headline come out, and these markets are so headline driven. I do think it was a nice piece to throw out there from the investment side, because now all of a sudden the hogs are now viewed as this global market, a lot of room to play in this thing. So possibly some change in overall supply and demand. Definitely a change in the investment outlook towards hogs.
All right. Well, thank you so much, Darin. Appreciate you being with us tonight.
Thank you, Mike.
That wraps up this edition of Market to Market. But if you'd like more information from Darin on where these markets may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us again next week when we'll examine the market impact of the Federal Reserve's decision on long-term interest rates. So until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.